Hello. Well, listen, thank you so much for coming today. For us, it's kind of an interesting conversation. So I'm David Ramirez, co-founder and chief investment officer at For Us All. We provide the ability for employees to invest directly into cryptocurrency from their 401k plan. And want to introduce the other panelists, starting with Dave.
Nice, thank you. Hi everyone, thanks for coming. Great that you were able to find the room, and if you came early, made it through the lawyers before us. So thanks again. I'm from Gemini. We are pretty much the most highly regulated full stack platform in the crypto space right now. So we offer everything from our exchange where you can buy and sell, you can use our earn product to earn, you can use our newly launched credit card to earn crypto rewards. And then we have an institutional business which is designed for ETF issuers who we'll talk about. So we act as the backbone for ETF issuers to custody and trade their underlying assets. We provide institutional services to hedge funds and a wide variety of institutions for trading and storage. And then lastly, for the advisory space, we offer a full stack portfolio management system to manage their business and their clients. It's great to be here.
Hey everybody, Joe Ziolkowski, CEO and co-founder of Realm Insurance. Realm is a Bermuda domiciled, regulated commercial insurance company. We launched in 2019, and I'm happy to say at this point, after nearly 3 years of operation, that we are the leading insurer to companies operating across the crypto and blockchain ecosystem, from companies operating in the mining space to developers of some of the most compelling, layer one protocols. We've done business for companies operating in more than 330 countries, both public and private. We offer traditional lines of coverage and innovative insurance products to deal specifically with some of the unique exposures arising out of the crypto ecosystem. It's great to be here.
Greg?
Hey everyone, I'm Greg King, founder and CEO of Osprey Funds. We have a Bitcoin fund that's traded under the ticker OBTC. That's the primary reason I'm here. But my background is building ETFs and other exchange-traded products across different asset classes. I put out the first VIX fund back in 2006, I think it was, and a lot of other firsts in the exchange-traded fund space. But in 2013, I bought some Bitcoin and then started to watch the personal account stuff, and the job converged. And so by 2016, we started pursuing a Bitcoin ETF. By 2018, I thought the SEC is not having it, so we pursued alternative structures, and that's what we're here to talk about today. Good to be here.
Hi, I'm Stephen McClurg, the co-founder and CIO of Valkyrie. Valkyrie is a full-service asset manager focused in mostly in blockchain. We have an ETF division, a private fund and trust division, as well as a hedge fund group that does everything from DeFi to venture. The ETF side is probably the most relevant to what we're talking about here. We launched a Bitcoin futures ETF on NASDAQ back in October. We tried to do it under the ticker BTFD, but people didn't like that too much, so we had to change it. And then we launched a couple of other ETFs, one that focused on companies that hold Bitcoin on their balance sheet, and then finally a ETF that holds Bitcoin miners, ticker WGMI. We're trying to be fun with the tickers. So those are really what we do is form in the realm of synthetics, I guess, or ways to access Bitcoin. We also do that in some of our private vehicles as well that we offer to institutional clients.
Great. So, I kind of have somewhat of a unique perspective, a lot of cuts and wounds from the last couple of years when we were developing the ability to allow employees to invest directly in spot crypto. And at the time when we started this, there weren't that many crypto products that were available. And for us, it was just 2 years of trying to overcome a ton of regulatory hurdles, a ton of challenges that a lot of traditional financial services institutions face if they want to provide their clients access to crypto. When I think about the products, a lot of it is about building that bridge, enabling different segments of society or industry to access cryptocurrency without having to go through all of those hurdles. So maybe what I'd love to start off with is just kind of a discussion. We've got an interesting group of folks, some that are producing products, other like Dave and Joe, that are providing the necessary infrastructure for that product development. First question really is starting with Dave, since you see both sides, product manufacturers and then folks coming to you for custody. Who are some of the institutions or individuals that are able to invest in crypto solely because these products exist? And what are some of the challenges that they've faced that led them to go the product route?
So I think what you're asking is why are they using products as opposed to investing directly, and what's that pathway, right? So I think it's a great question, right? So there's a lot of reasons why people would use crypto products before they would go directly. I think it's generally an evolution where you start with a product for a regulatory reason or for a convenience reason, or often because that's the way you're managing the rest of your assets today. So the products that Steve and Greg offer, they're a natural segue to you have a 60-40 portfolio, bonds and equities. You want to add a crypto sleeve into your you want to add a piece of crypto into your alternatives. You might buy a Bitcoin ETF or an ETP. Right now in the U.S., for U.S. investors, that's slightly complicated by the structures that they've allowed and haven't allowed, right? So you're not getting physical Bitcoin. You're not getting, and when I say you're not getting physical Bitcoin, what that really means is you're not getting perfect tracking with Bitcoin. You're getting either a closed-end fund or a futures-based fund with nuances to it. What I think it's interesting, and you mentioned this concept of around the bridge, I think that's what happens, right? And I think that's part of what's holding the SEC back as well. It's you start to invest in Bitcoin, you learn about the rest of crypto, and I know I'm not allowed to mention the rest of crypto at this conference, but it exists and people start to delve deeper into it, right? So the Bitcoin ETF or the Bitcoin product acts as this bridge. So that's where people start. What's interesting also about these products, and I'll bring it to a close quickly, is the listed products actually bring lots of different styles of investors together, which is what's great about them. Institutions, retail, market makers, hedge funds, non-financial users looking to hedge portfolios, so miners looking for hedges potentially, they all come together in ETFs or ETF-like products, which is what's driven the growth of those products to $10 trillion over the last 20 years. And so it's a great place for a base set of liquidity for future growth in the rest of the asset class.
What about you, Joe? So in terms of providing insurance to a lot of different players, have you seen instances where organizations came to you originally with the intent of investing directly in spot and ultimately faced some challenges that really going the product route was?
Yeah, I mean, there's two sides to it, right? I mean, you've got, great asset managers like these guys over here that are putting all of this brain power and working through the regulatory hurdles to launch the product, these products that the market needs, right? For some of these investors that are interested in the investment opportunity but don't want to actually hold Bitcoin itself, right? And you go through all this legwork and then you find out in order to actually get this thing launched, I've got stakeholder requirements that require that I get insurance, right? So where did this insurance thing come from? And they're now kind of confronted with the complexities of their product coupled with stakeholder requirements, where I think a lot of people in the crypto space have come to realize that insurance is a mission-critical part of commercializing Bitcoin-related products, and it's also a really important part of getting institutional investors comfortable moving in the direction of alternative investments, right? So when you look at alternative investors who are pumping a lot of capital into traditional financial products that want to potentially dip their toe into a Bitcoin ETF or Bitcoin trust, it becomes a function of how do I satisfy risk management requirements in order to green light the movement of capital in this direction. And they need to ensure that there's adequate insurance around the custody of the Bitcoin that's backing the shares, that the asset managers have professional liability policy that they can claim upon in the event that there's some sort of negligence or oversight. And so really what we've seen is from both sides of the equation. The guys launching, the companies launching the products that need coverage in order to satisfy compulsory insurance requirements, and then institutional investors that need a regulated referenceable, familiar source of financial recovery in the event that things go wrong.
Well, I'm curious, Greg and Steve, how have you seen the investor base change over the last couple of years? Are you seeing increasing interest from institutional side versus retail? And then if institutional, which specific areas are you seeing the most growth?
So one thing I'll say just generally about like why we do this, because when you're around a bunch of diehard Bitcoiners, it's like, why would I need an ETF or any kind of wrapper? I'd just buy it. But everybody's got constraints, you know, and I mean, I hold Bitcoin, of course, directly, but also in my brokerage account, I hold our funds, et cetera. And so you have to realize, I mean, I was thinking of analogies and I thought about Uber Eats, right? I mean, Uber Eats is part of my life now and it's kind of permanent. And I mean, I never ordered in anywhere near that much before, right? It was about taking yourself out of your house and going down to the restaurant, and now you can have it come to you. So I think it's the same thing with investor portfolios. It's like, sure, in a perfect world, you could just move your assets around indiscriminately between different kind of pockets that are constrained in various ways, but that's not the world we live in. And so what we do is solve for those problems and give people access in ways that bring the solution to them rather than forcing them to kind of unwind what they've already got going on. The other piece I'll add to that is financial advisors care about moving your assets around, right? So, you know, most people who have significant assets have somebody looking over them, and you know, this is all sort of in flux and being built. And so what I'm saying now, you know, may not be true in 5 or 10 years, but in a lot of cases right now, it's difficult for those advisors to manage the overall assets of their clients in a portfolio context, including their crypto holdings, right? Because a lot of times those are outside the realm of their systems. And so building investment solutions helps fix that problem and helps the advisor do a better job for their client.
Yeah, you know, I think it's important to kind of segment the various investor groups out there. You've got individuals, retail. You've got intermediary, which is financial advisors buying on behalf of other people. You've got fast money, which are hedge funds for the most part. And then you have institutional investors, which would be life insurance or property and casualty insurance, sovereign wealth funds, and pensions. And that, by the way, is the biggest segment. And that's, to me, is what everybody's waiting for to come in. Out of all of those groups, really, ETFs are going to service the intermediary group the most. And that's going to be your financial advisors buying on behalf of others. And that is a very large segment. So when there is finally a spot ETF, you're going to see that segment thrive. That's the segment at the moment that has the most interest in the ETFs that Valkyrie produces. Individuals, for the most part, you know, I diversify, right? You know, hardware wallets can fail, but I still use hardware wallets. A exchange can be hacked, but I still hold it in an exchange. Every different wallet type out there has its own upsides and downsides. And so I like to diversify, and I think a lot of people do that as well. A lot of people will go to an exchange like Gemini, purchase, sometimes hold it there, sometimes move it to a hardware wallet, and that's great, you know. And I think that's really the retail audience. That's where they're going to go. I don't think they're going to go into a Bitcoin ETF so much. And then as far as institutions go, institutions aren't really big buyers of ETFs, right? I think a lot of people believe that they are, but they're not. You know, if you're a pension fund, you don't go out and buy ETFs. You hire a manager that charges less fees to do the same thing in a separately managed account for that pension fund or that insurance company. So I don't think ETFs is going to have the impact that a lot of people believe, or everybody's going to be buying it. I think a certain segment will, and it will have an impact. But it's really important to point out that some of the products that, for instance, Valkyrie builds is for the institutional class, so that they can buy and hold, you know, various things like Bitcoin. But no, ETFs I think are really going to be a game changer in the intermediary space.
Well, talking about the current products that we have now, what are some of the limitations resulting from the inability to invest directly in spot?
Yes.
Yeah, on the ETF side.
Yeah, so I mean, look, a lot of the limitations on spot is if I'm a sovereign wealth fund or I'm an insurance company, I'm not going to go out and open up an account on an exchange and just buy directly. By the way, some are doing that. They might. But really, the preferred way is to invest in a fund structure. That's what people are used to. You have to understand the people that manage money for institutions, their primary goal is also to protect their job, right? And if you're going out and setting up a wallet or setting up an exchange account and something goes wrong, and you transfer it to the wrong wallet or something goes wrong, I mean, you're done. It's one of the reasons why when institutional investors, when they choose which asset managers to work with on things like bonds and equities, nobody's going to lose their job by choosing PIMCO or BlackRock. Some of the smaller ones might have better returns, but there's also a risk in investing with them as well. So same thing goes with let's say Bitcoin, right? Opening an exchange account and buying Bitcoin directly, that's pretty risky. But investing in an asset manager that has a fund, that has a third-party custody, that also uses a third-party fund admin, that also uses a third-party pricing agent and a third-party auditor, that's safe. And that's where institutions are going to go. They're not going to buy an ETF charging 75 to 95 basis points. They're going to buy a fund that charges 30 to 40. And that's where that world is going to go. And that's why that's important down the road.
Well,
yeah, I agree with Stephen, but just to add, I think that the other thing institutions are looking for is diversification within crypto, and I agree. I know I'm not supposed to mention the rest of the world in terms of the crypto out there, but you talk to institutions, they want, they're not going to give you a mandate for just a Bitcoin account, right? They want to understand how to diversify within the space and what the recommendations are there, et cetera. Plus all the stuff that you sort of mentioned around the mechanics. So there are a lot of limitations, especially when you consider that, at least in the US, Bitcoin's a commodity. And so holding, a lot of investor policy statements and like investment guidelines at the institutional level, don't provide for much, if any, investing into commodities. It's all about stocks and bonds, and so there's a lot of sort of internal red tape and hand-wringing about how to get the exposure in a way that's compliant with their mandate.
right.
And the one thing I would add to that too, and Steve, I think you brought up an interesting point. If you look at the amount of capital that exists in the insurance space, right, and the fact that it's looking for an opportunity for a safe yield, there should be, and likely will be, a ton of momentum moving toward the products that you guys are selling. Interestingly, we're one of the only commercial insurers, actually the only commercial insurer in the world that has a license in Bermuda. It's called an IIGB license that actually allows us to hold crypto on our balance sheet. Right, so we work with our institutional custodian, Gemini, to actually hold Bitcoin, for the idea of using and building reserves in Bitcoin so that we can actually denominate custody insurance in Bitcoin for participants on these exchanges.
But by the way, in case you haven't figured out, we're all in bed together. We use Realm for insurance, we use Gemini. We don't use each other, but we're friends. We're frenemies, right? We have competing products, but we're still friends.
But you guys didn't tell us about the gray pants, black shirt dress code for today. That's a little pissed off right now.
We all planned that.
Do you guys think that, can I ask a question?
Yeah.
Do you mind? Isn't there a chance, people actually don't need funds to buy Bitcoin, right, or Ethereum, right? In theory, they don't need the synthetics. But what they need is the asset management baskets, right? There's thousands of tokens that don't exist that they may want to invest in that they would probably use you for. Is that the way you think your businesses may evolve over time, more into that than the core?
You mean, are we going to have more products besides just Bitcoin?
More sort of investment management, not just access vehicles.
Completely.
Baskets,
the fact that I had to build this OBTC thing is just a function of our regulatory environment being, let's call it, not caught up to where the people are, right? I mean, we should have a spot Bitcoin ETF. We should have had that a long time ago, and spot other crypto ETFs, and that's the base layer, right? But let's take, for example, somebody like Kathy Wood, right, runs the ARC ETFs.
She's now a Bitcoin maximalist downstairs, by the way.
She is. Yeah. So she has to buy our products. She can't buy Bitcoin directly, right? She has to buy securities within her fund if she wants exposure to Bitcoin or other. So you're really talking, this is an indication of kind of how early it is. The capital markets kind of ecosystem is still just the basic building blocks with single access products. And then it goes to the, the kind of typical story in financial services of diversification and a broadening out, right? So you'll have a 100 crypto basket product at some point, in the next several years.
Yeah. But by the way, not everybody may understand this. And I was having a conversation earlier. There was a question about, well, why is it important that, it's a 33 Act product versus a 40 Act product versus this other structure? Something to really keep in mind is Bitcoin is not a security, right? It's property, right? And when you're buying and selling property, whether it's real estate, Bitcoin, or gold, or whatever it is, it's not a security, and it's not regulated as a security. So a lot of fiduciaries are required to purchase things that are a security. So once you have Bitcoin in a fund and you've wrapped it in a fund, the fund itself is now a security, and now they can buy it. And there's a difference between all the different types of security wrappers. So, like an ETF, for instance, if you're running an ETF or a mutual fund, you have to purchase other securities for the most part. So buying Bitcoin directly doesn't qualify. Wrapping it in a security and then buying that security, or getting kind of the same thing except fees on fees, now you're able to do it. So that's kind of where our regulatory system is.
So I'm interested in the regulatory system. Some might argue that maybe our regulatory environment is not evolving fast enough, fast as, say, Canada. And specifically with respect to futures-based ETFs, what are some of the impacts, particularly like contango bleed? How's that impacting investors by virtue of not being able to invest directly into the spot?
You just
crypto?
dropped a phrase on this audience that I'm not sure.
Contango bleed. So let's talk about
contango bleed.
If you can describe right now with the ETFs in the U.S., you're able to invest in futures, but not the spot crypto. And so, how do you actually do that? And what's the impact of not being able to invest in spot crypto?
No, I mean, Greg said it. It's contango bleed. So the way that the way that it works is when I'm going to say two different things here. So the way that it works is every time futures expire, and every time they expire, about to expire, you've got to roll into the next set, and there's a price differentiator, and that price spread is either how much you lose or how much you gain in the spread. Usually you lose. But over time, sometimes it balances out, usually it doesn't. And that's something that's really important to know. The interesting thing, though, is investors are used to doing this, right? If you want to have access to gold or oil through an ETF, which a lot of people do, or other commodities, what's happened over the years is there's an ETF that holds futures of things like wheat, oil, whatever you want to put into an ETF. But they're used to that future structure because futures are regulated by the CME, the structure itself is regulated by the SEC, and investors can get comfortable around it even though there's a cost to doing business in futures itself. And that was one of the things that Chairman Gensler really hit on, was like, look, first of all, we've got this regulated product within a regulated product that gives comfort to us. We're willing to do that, and that makes sense. Second of all, when we first started launching Bitcoin futures ETFs, they said only in a 40 Act product. And people were like, well, why would a 40 Act versus a 33? And I know I'm kind of probably talking some technical jargon, but what I'll say is 33 Act is the 1933 Act is a set of rules and regulations that regulates on a very simple basis. The 1940 Act is another set of regulations that includes the 33 Act as well as the 40 Act. So really the jargon is we have extra rules if you do it in a 40 Act versus just a 33. And so that is like that extra layer of comfort that they're really prescribing. So look, I think it's a first step in greater things to come, which is why we participated. But there's a few more steps, and then I think we get there.
So I will
Take the other side of that?
I will take the other side. because I created one of the most contango bleeding products ever, the VIX futures product, right? So the reality is that there's chuckle from Ed. Thanks, Ed. There is a when the futures price is above the spot price systematically, and you're buying that every month, and it's riding down like this, you're basically buying high and selling low. So that's what the bleed part is about. And if that is 1% a month, then you're going to lose like 12% a year trying to track the price of Bitcoin. That number moves around, and so that's the con of that structure. The pro is it got approved. It's SEC traded. Our product is spot, so we hold the actual Bitcoin and a custodial account. But then the product itself trades at a premium or a discount, just depending on supply and demand in the market. So right now happens to be at a discount. Just saying. But it waxes and wanes, and so there's really no optimal structure right now. We're just trying to add value to the ecosystem by providing access products with, 1.5 arms tied behind our back. But I think the SEC is slowly getting there. I think the White House directive was helpful, although I don't know that it moved specific projects along. But I think just to set that tone was helpful. So we're getting there.
I think the regulations are necessary. Sorry, Matt. Go ahead, sir.
Yeah.
I think the regulations are necessary. The SEC is definitely moving in the right direction. Yesterday, they approved a 33 Act fund. So I think it's a step towards, I actually think it's a fast step towards the world of Bitcoin ETFs changing, because I think physical is going to come on the back of this. So I think your guys' businesses are going to sort of change and explode in a way where you're going to get physical this year, it looks like, based on the way the regulators are moving. I think the hardest part is they're not navigating liquidity in the markets or market manipulation. Those are not the concerns. I think one of the most difficult things to get their heads around is the day they approve a physical Bitcoin ETF, they're going to have filings for the ETH ETF, and then they're going to have filings for Solana, and then and everything else, right? And
just please no Ripple.
Yeah. And so it's a massive slippery slope in terms of how do they navigate that, right? And that's what we're seeing from our clients, right? Like we obviously support the funds, but our clients use Gemini or platforms like Gemini because in their worlds there's more than Bitcoin, right? And that's I think one of the things that people are going to have to navigate as we go forward.
And the thing I was going to add to that, you're right. The regulatory clarity is critical. But there's also kind of a mandate too, I think, for the insurance industry as a whole to make sure that the asset managers that want to access the products that you guys are offering are covered by the professional liability policies that they have to have in place in order to make investment decisions on behalf of their investors. We come across a lot of, middle market asset managers that are enthralled with what's going on with Bitcoin and Bitcoin-related products, but they literally cannot allocate clients' assets because the professional liability policies that they're purchasing exclude any claims arising from these types of investments. And if the insurance industry has a better understanding of the fact that what you guys are offering is a very safe and very regulated and very measured way to gain access to the crypto economy, I think it would give these asset managers more latitude to actually start participating and committing a more meaningful volume of assets toward these types of products.
And, I'm interested, Dave, from your perspective with regulation. So certainly when the SEC first started talking about spot crypto ETFs, two of the chief concerns were around safety of custody and potential market manipulation. As somebody on the custodial side, what were some of the key things that Gemini and others have done to help educate regulators on best practices in custody?
Look, we've spent hours with regulators educating them, right? And this is a process. This is not a new process, right? I spent the last 20 years educating regulators and investors about ETFs, and now I've moved into the Bitcoin or the crypto space, and this is sort of rinse and repeat, right? Education, education. We will be educating investors and regulators about this space for the next 20 years, right? So it's not something new. I actually don't think the U.S. regulators are behind by any means. The U.S. regulators are not paid to be first. They're paid to be right? And so, yeah, people say that Canada and Europe are so far ahead of us. We wield such a bigger sword, right? That once we get there, it's going to have such a bigger impact on the industry that they want to make sure they're taking the right steps on the way they do it, right? And I think that so it's just a process in that sense, right? And I think the the regulators are doing a great job. Like, they're really digging in. The questions we have fielded, the back and forth. I mean, Grayscale blew up basically the SEC website with their comment section, right? And don't think those comments all went unread, right? They were smart. There was a lot of really intelligent comments written and read by the regulators, right? And there's a lot of, Bitwise has done a tremendous amount of working with those groups. These guys have both done a tremendous amount of working with the regulators. And I think they're like I say, I think they're getting up to speed. I think the first step will be this Bitcoin physical ETF this year. And I think it's going to be, I think we're talking about $100 billion industry of crypto ETPs in the next 5 years. I would not be surprised to see those numbers. And I think that's going to be, there's just so many opportunities here. Yeah.
Look, that was one of the key areas that regulators had trouble with, was custody.
Yeah.
I mean, it was the key item, and it took years. I mean, I think the first time I sat in front of regulators was in 2017 to talk about the custody issues. But I want you to put yourself in their shoes for a moment, because a lot of us would just say, no, the SEC is bad. They won't let us have a spot Bitcoin ETF. But put yourself in their shoes for a moment, right? We used to 2016, 2017, 2018. Well, look, we go all the way back to Mt. Gox, right? You have these custody solutions that get hacked, money gets stolen, and yeah, these are rare events, but they make headlines. And if you're a regulator and there's constant headlines about a hack or money stolen, or the founder plays dead and runs off with the money to India, it's like you get really nervous, and you want to make sure that you're trusting, you have an obligation to shareholders across the US, and you have an obligation to make sure that they're doing something that's safe, that's Gemini is actually one of the groups that's been leading the way. The second hire that we made at Valkyrie was a chief information security officer. We wanted to make sure that all of our funds were safe, and all of our clients' funds were safe. And we worked very closely with multiple custodians, not just one, right? Multiple custodians, and then educating various regulatory agencies on why we believed that they were valid, as well as them getting in front of them and showing that they're valid. Right? I mean, it's been a long process.
Yeah, the custody,
we still have a lot of work to do.
The custody piece is like well-worn, right? So when the Winklevoss filed for a Bitcoin ETF in like 2014, 2015, Gemini didn't exist at the time. And one of the things they heard was that custody, institutional class custody, didn't exist. So they set about building Gemini, right? And it looks like a traditional institutional custodian, like any of the big custodians that handle stocks and bonds and things today. That's what Gemini is, right? And it's New York Department of Financial Services regulated, SOC 2 compliant, on the exchange and custodian. These things they check all of the boxes on an institutional RFP, and that's what was really needed to bring this industry forward, right? And I think there are lots of, like, people mentioned the Mt. Gox hacks. There's never been a hack at Gemini. Like, these institutional custodians, even our closest competitors that are regulated in the US, they don't have these issues anymore. They're not real, right? Like, they're sort of outside, around the periphery. They make the news because they want to, draw eyeballs, but they're really sort of peripheral to what's really going on in the institutional custody space.
I know this isn't necessarily all about a Bitcoin ETF, but it is, synthetic Bitcoin products.
Yeah.
So just one more thing one more point on that. Where my jury is still out in terms of the SEC getting comfortable is the other big piece besides custody
is market manipulation, right? And so at the end of the day, everything's linked together, including futures prices, which makes that a little bit confusing. But the fact that Bitcoin's a global asset, the vast majority of the trading volume happens outside the U.S., and it's really unsupervisable by the SEC or any U.S. regulator, is, I think, the last mile, right? That's what makes them nervous. If by some miracle, the exchange proposal, the definition of the word exchange gets broadened to include crypto exchanges in the U.S., A, and B, the world's volume starts to really kind of pool there, then I think we could be in that territory. But of course, regulators get to do whatever they want, whether or not it's rational.
Yeah, that's right.
Well, in some of our discussions with regulators, especially after the executive order, one of the themes that keeps coming up is taking a fresh look at what investor disclosures and mean in the context of crypto. So I'm just curious, do you think it needs to change? Should it evolve? Should the crypto industry, whether providing spot access or products, need to meet a different bar in terms of educating particularly retail investors?
I mean, I can say, I know you guys have an opinion on this, but we have been privy to these registration documents and the number of back and forth and Q&A, and I mean, it goes on for months and years, and millions of dollars are spent responding to the SEC to try to get them comfortable with launching these types of products. So there's no question that they're being subjected to a higher level of scrutiny. And when you incorporate a new technology and an asset that has a lot of headline risk, I don't know that it's getting any easier, but maybe it's come a long way.
No, I mean, I feel like, I'm sure you feel the same way. The risk disclosures, if anyone bothered to read them, are voluminous, right? They're above and beyond. And so it's really what you're asking is there a way we can force people to want to learn more? Because people are people, and sometimes they just say, I'm just going to do this, right? And really it's about, do we want to be in a position to try and alter that behavior for their own good? And that starts to get into questions about, individual sovereignty and things like that. But personally, I'm fine with the level of risk disclosure that's out there.
I mean, look, most risk disclosures are pretty boilerplate anyway, and the first time you go through a new asset class, you're paying a lot of lawyers a lot of money to build them out, and then the staff will comment on them, then you've got to build out more, and then more and more. It's a great way for lawyers to make money. So, but you're right, people really don't read them. I actually think there's a lot more risk at a lot of other asset classes than there is in Bitcoin that's not disclosed, right? So, yeah, look, now that there's what we call like a body of work for disclosures, it is pretty boilerplate. It's cut and pasted in, and a lot of it has gone through SEC scrutiny, so to speak. There's a whole division of the SEC, and that's all they do is review risk disclosures over and over again on products. So, but I think this first round of Bitcoin futures ETFs that have come out have sort of verified that body of work, and then from here on out, it's pretty easy just to cut and paste them in. But you'll get charged as if they're fully written each time.
Bespoke each time.
Well, maybe one final question. What do you see as being one of the biggest impacts of the recent Biden executive order on crypto?
I'll jump in. Look, he's basically saying, come up with an answer, right? You can analyze forever. Let's come up with a first shot at some answer, right? It may not be the end result that we may get 2 years from now, but at least let's lay some clarity on the table with some regulations. And so I think that's a great thing, right? We talked about what types of investors, right? Direct investors actually don't need a bunch of sort of framework around what they buy and sell now, right? But like was mentioned before, institutions, and which we think of as really the largest pool of money in the country. There's something like $50 trillion in advised assets, either run by asset managers or advisors. Those firms invest in, when they invest, they need clear a regulatory pattern around it, right? Regulatory clarity is what they need. So this movement towards at least let's come up with some answers enables that entire swath of money to not have to go around regulations to find different ways to invest. And that's better for investors, it's better for the managers, it's better for everybody.
And I would say it's better for insurers too. I mean,
Yeah.
trying to evaluate risk when there's no real regulatory framework to frame the discussion about when an asset manager or when a new investment product is compliant or not compliant makes it difficult, especially for a slow-moving industry like insurance, to really get comfortable with and move into meaningfully. So the more regulatory clarity that I think we can get is going to put some of the picks and shovels aspects of the service around these types of products easier to provide more support.
Yeah, I have just a high-level takeaway. It's constructive tone, really. That they struck a constructive tone, and I think that's a signal to regulators everywhere that's very positive for those of us holding Bitcoin and those of us manufacturing products around that.
Well, I think that music is a signal that our time is up. So thank you all so much.
Thank you. Thanks.